So I think, we've covered most everything. One thing we haven't talked about that is really confusing to people is debt and debt to income. And
Yeah.
what is that? How does it work? How does it affect people? If you've got some things you need to pay off, should you get pre-approved anyway? Like, what's a lender role in helping people determine what their what I call it's DTI, debt to income, and what would need to be paid off or not be paid off, how all that works, and then what's included in debt? Is it my my trash bill, my electric bill,
No.
or
Yeah.
that kind of thing? If
Yeah.
you kind of want to give kind of the overarching spiel on your
Yeah.
debt and DTI.
Yep. Yep. So debt to income. And the way that you would calculate that, you mentioned trash bill or utility bills.
Yeah.
Those aren't debts. You might owe something each month, but there's not a balance. Hopefully you're on time on those things. But it's like where you actually go and you take a loan out, and that therefore generates a monthly payment. And one thing that people can get confused on are like student loan payments that are deferred. Depending on the loan program, there's a lot of cases where it may be deferred and it may say $0, but depending on the government agencies may require the lender to actually count a monthly payment.
Sure.
So that's why it's important to get with us, because you don't want to just assume like, well, I have $100,000 in student loan debt, but it's all deferred. It's zero payment. So you don't have to count any of that. Not necessarily. So you take all of your monthly debts. This is also one thing that's been coming up a lot is like Affirm and Clarion and these things where like if you're going through an online retailer like Amazon, for example, it gives you the option to not make the full payment, but instead make payments
Yeah, the short-term
for whatever
credit
you're buying.
options.
Yes, we
Yeah.
ask that up front now because that's not going to come up on your credit report, but it is going to show up on your bank statement. And the loan programs do require the lender to count those payments into your debt to income ratio.
Yeah.
So we take all of your monthly payments for the debts that you have, not utilities, not trash, not internet, just the things that you've actually taken a balance out on. And then there's a monthly payment
Auto,
generated.
credit cards,
Yep.
loan
Yep.
programs, things like that. Yeah.
Divide that by your income. Now, the nice thing is that we are able to use your gross income, not what hits your bank account, but most of the loan programs allow us to use your gross income. So I know that most people have health insurance taken out. They have taxes, of course, taken out. They have 401k contributions taken out. We're able to use your gross before those things are taken out. So you have your monthly payments. You can add that up, or we can do it for you. We do it for people all the time. Add that up, divided by whatever the monthly gross amount is. Now, if you're paid a salary, that's easy for us to calculate. If you're hourly, but your hours kind of fluctuate, there's a certain way that all lenders are required to count that. And then, of course, we have bank statement loans for self-employed people. There's other special investment property loans. That's a whole other thing. That debt to income ratio is it's different in those scenarios.
Yeah. Yeah. And so if somebody's got, credit card, say they've got, I don't know, $1,500 on it,
Yeah.
and that's throwing their DTI off. I know Adam in the
Oh,
past
yeah.
has been
Yeah.
able to help people kind of resolve that in the loan process to get
Yes.
them closed. And so,
Very, very common
yeah,
where they might have 5 different loans or maybe 10 different loans in order to buy the house that they want and get the payment where they want it. Part of it might be maybe they have some money to put down, but we have them put a little bit less down so they can use those funds to pay some things off at closing.
mm-hmm.
And the benefit there is then we don't have to count those monthly payments into the debt to income ratio. I do tell people if you've not started the home buying process and you pay things off, that's fine. But if you're starting the home buying process, you meet with us, we pre-qualify you. We
Yeah.
actually encourage you to just make your normal monthly payment, and then we'll take care of paying those things off at closing because it's less documentation.
Yeah.
If you send a check off a week away from closing to go pay something off, I know you're trying to be helpful for your lender, but the lender's got to wait for that check to clear, for it to post, and then get verification from that provider that it's been paid off. And I've seen situations where that's delayed closing, whereas if they would have just waited, brought that check in with them to closing,
Yeah.
the day of closing, then the title company verifies that it's going to get paid off. and we don't have to wait for the check to clear to get posted, all those things.
Yeah, we're all about smooth process in our world.
Yeah.
We
Yeah.
ideally speaking, I would like you to be like, man, Zach and Adam, they didn't do a whole lot because we're doing it all on the back end because we're making it simple, right? And
Yep.
so
Yep.
that's the ideal world. We get into a long my tangent about people that say we don't do a whole lot, but a good realtor and a good lending partner, especially when they work together, should feel to you as a client like things went real smooth, right? And so,
Yeah. Yep.
but there's a lot of prep work and just a lot of knowledge that goes about how to do things so that you don't have issues that go into that. So